Felix Zulauf, I treasure every interview that I have with you. Thank you so much for your time. It's just so good to see you. How have you been?
Oh, it's a great honor, Ed. It's always a pleasure speaking to you, and thank you very much for inviting me. It has been a difficult year for me because I try to think and I try to time, and the straight line up is usually good for the buy and hold strategy, but more challenging for me. But I don't want to complain. I had a big position in gold, and gold
Uh,
was doing very, very well for me. Yeah.
well, you're not alone in feeling challenged at the end of this year. That is for sure. Could we start, Felix, by maybe just having you explain to our audience your investing style? How do you invest? How do you look at the markets? And what's your time horizon?
Okay, I look from the very long term and then I work backwards to the short term. So I look at secular trends and then I look at what I call the business cycle or the mini business cycles and the 4 year stock market cycle in the markets. And then I go down one level deeper to intermediate term trends, which is 3 to 6 months or so, which is most important to how I invest or how I trade, so to speak. And then the trading swings that are more 4 weeks up and 3 weeks down and things like that. This is how I operate. And I'm a macro guy, so I start from the top down. I'm not a bottom up company analyst.
Mhm.
I go top down. I look at what's changing in the world and where the world is moving to and what they could mean for asset prices. So it's like in ice hockey, you should not go where the puck is right now, but where it will be soon, you know. So I look at the major economic blocks, China, Europe, the US, and how they change and the policy they are setting and what they may mean for capital flows, which are then recognized in the forex markets, and what it means for interest rates and what policymakers at central banks will do and what fiscal policies and where the market stands and what's priced in or what could be priced in and what's not priced in. And this is how I work.
Okay, you
And
said you look at what's changing in the world. I almost wonder if this year you could have said what's not changing in this world.
yeah, that's, in my last report to my subscribers, I wrote that in geopolitics, we have seen things happening in a week or 10 days that you usually see happening in a few years.
Yeah.
So it's wild, and it's all part of a changing world. And it starts with geopolitics. The old unipolar US-centric world order is falling apart, and I think everybody recognizes that. Maybe the US deep state does not or wants to
Mm.
defend it. But we go to a new world order and we do not know what that new world order will be. And it's a transition process. And that transition process in geopolitics, in the power play and the struggle to position itself for every nation, there are sorts of ramifications for the economy. And you will see now with Donald Trump, he will try to make America great again and he will try to de-risk the US more or more friendship and deglobalization, whatever you call it, it's the same thing. You reduce your risk on the supply chains and risk to other trading partners and you go nationalist, and that's a new trend. We go nationalist or regionalism. The Europeans will try to do that because they have no choice. The Chinese will try to do that, and America is trying to do that. And of course, that has certain ramifications because in that process along the lines, we will move further and further towards state capitalism. And state capitalism means that the government dictates the investors where they should invest, and it dictates the investments that should be taken. For instance, if the Biden administration says to Taiwan Semiconductors, if you want to sell your products, you have to invest in the US. We help you a little bit, but you have to do it. And a next step will be they will tell the pension funds, you have to buy more government bonds or whatever if you have a financing problem at the treasury and things like that. We will see much more of these things, and in all three blocks. I mean, we know that from the autocratic system, the Chinese do it that way, but I think the so-called free world will do more of that in the future because they want to de-risk. They want to make sure they have the infrastructure and the manufacturing capacity in place they need for their own needs, for their own national economy. So I think that will be felt more and more, and we are somehow exiting the old world of free markets, where people, individuals, entrepreneurs could decide, where do I invest? Be it in the securities market, be it in the real economy or wherever. The individual and the corporation decide it. And I think that will be more and more guided by national interests, and we are moving away from the world we come from. That will eventually also have an effect on currency markets. I mean, in the last few years, the dollar hit the low in 2008 or 2009, and it has been steadily going up. And capital flowed into the US because the US was the best place to be. And, at some point of time, the Chinese, the Japanese, the Europeans will say, well, wait a minute, we need that capital at home. So you should not move that capital there. Bring it home, repatriate. We will help you at home, but we need that capital. And therefore, you will have so much interventionism going on in that sense that I call it state capitalism. It's a different world we are moving to. And most of the analysts, portfolio managers, investors are still operating with the software of the old days, of the old system. And I think in the next few years, we will see more of those influences and financial repression and things like that. And that will have an influence because there are no free markets. And if you do not have free markets, then you do not have the classic conventional business cycle behavior, because it all gets distorted.
Right.
And that's the world, and that is how I see the world changing. And it's very difficult to web that into your analysis because we are all indoctrinated and conditioned by the past. So we always look at the past and how it was in the past, but things are changing, and that makes it more challenging. This could also be that we have now a situation where the US stock market is near its historic highs in terms of valuations. Whether it's the highest valuation or the second highest valuation, one can debate, but it's in very high excessive territory. It can get higher, it can go higher because of all this, because the capital flows into the dollar may last a few more months, may last into 25. And maybe in 25, we see the first repercussions of what I just described before, and some begin to repatriate.
Was COVID the catalyst that made the sort of past models irrelevant, or was it before that?
COVID was an influence in the mini cycle. COVID was an influence, but I think it started before that. I realized it in 2018 when Trump started with tariffs against China. And I realized that this is a beginning power struggle. And there is a theory, the Thucydides trap, which is what an old Greek guy 2,500 years ago observed, the power struggle between the hegemon and the rising challenger. And that's the situation between the US and China. And I think that was the beginning. And in 2018, I began to write about upcoming wars. And it usually starts with proxy wars. And at the end, it could go to a direct war because in the last 500 years, we had 16 such changes and 12 ended in direct military conflict. Three were proxy wars, and one was peaceful, from Great Britain to the US, from the mother to the daughter, so to speak.
Okay.
And then I realized the changes, but I was probably not fully aware to where it would lead to. I think I see clearer that it will lead to state capitalism because we are sort of the end of the road in terms of normal, conventional government behavior due to the debt situation. And the debt situation is getting worse and worse because we do not have the demographics to support the growth rate that we need to keep the system running without any problems. And because we do not have the high growth rate that is needed, central banks and fiscal authorities are trying to work overtime from time to time to bring the growth rate up. And all it does, it leads to inflation and it leads to high debt and it leads to problems in the systems. It doesn't solve any problem because the causes, demographics, and over-indebtedness and regulation or over-regulation is not really attacked. Now, Trump is the first one trying to do that. And I think I applaud what he wants to do in terms of Doji.
Sure.
I'm not sure he will succeed because you fight the bureaucracy. And the two guys, Elon Musk and Vivek, they cannot really direct to the bureaucracy what they have to do. They can only suggest. And then it's on the executive board, which is the cabinet, to do what they suggest. So I'm not sure it will work. If they cut out half of what they said they would do, which is $1 trillion about. They said $2 trillion. If it's $1 trillion, it would be great longer term, but it would be bad short term because one guy's expenditures is another guy's income. And if you cut that out, $1 trillion, you cut out 3.5% of GDP. That would hurt. And then you come to tariffs. When you go to tariffs, a tariff is a tax. Either the consumer has to pay it by higher prices or the producer has to pay it by lower selling prices. I mean, it hurts. It's a tax. And if one guy taxes the imports, another guy who gets taxed will react and will do the same. The Chinese will not just sit there and say, oh, that's too bad, let's remain friends. They will do the same. And they will hurt US companies operating in China. And if it hurts the Europeans, they will retaliate, etc. And I just, most people have forgotten that a medium-term correction in the stock market from October 1929 at high levels, agreed, high levels, not as high as today, the medium-term correction. Then in June, they introduced the Smoot-Hawley Act in June 1930. And then hell broke loose. And we went into a depression and a complete meltdown in the stock market. I'm not comparing the whole situation with then, but I just want to outline the risk there are. Tariffs historically have not led to prosperity, just to the opposite. So we should be aware of that. So 25 will be an interesting year because we will learn how Trump wants to handle the situation with China and the other trading partners. And if he overdoes it, there are risks. And we do not know those risks yet. We know what they could do. When you look at the tariffs that he talks about, we are we are at similar tariffs that were used in the period from 1900 to after World War II. If Trump would do only half of the tariffs that he suggested, let's say 5% to everybody and 30% against China, that would be the tariffs that were in place from the beginning of World War I to the end of World War II. And when you look at that period, aside from the wars, it was not a pretty economic situation. So tariffs have not been good, and those are the risks. But of course, there will be negotiations, and the tariffs may not come from day one. I don't know. We do not know really. We will know after January 20th. But those are the risks we will have to deal with going forward. That's the situation in the US. Of course, Europe is the weakest. Europe is in a terrible mess. They have gone, particularly the center of Europe, has gone totally green energy, and they were caught in the war, Ukraine, Russia, and the sanctions and all that. So they have now doubled or sometimes tripled the cost for the corporate sector in terms of electricity. And you know, every economic activity is translated or transmissioned energy in a way. And if that factor is up twice as much as it was before, or three times as much, it hurts you and you become uncompetitive. And then the key industry in Germany, which is really the center that really drives Europe, is the automobile industry. And the automobile industry has fantastic cars, and they are far ahead against everybody else in combustion engines. But now it's electric vehicles. And in electric vehicles, I have driven some Chinese vehicles down in New Zealand at the beginning of the year. And, you know, they are like a Porsche. Same thing.
Really?
But same thing. The technology is very similar, is as good as the German technology. The batteries are at least as good, if not better. The interior design is as good and as fancy as a German car. It's fantastic. And they sell it at 1/4 of the price.
The CEO of Ford said not too long ago that he had a top level Chinese EV imported so that they could test it. And he had been driving it for 4 months, and it was time for him to give it back, and he didn't want to.
Yeah, okay. So that is the story. That is the story. Of course, China has its own problems. You know, China has overdone it in real estate. They are sitting on 100 million empty homes, on tons of non-performing loans in the banking system. The banking system is undercapitalized, needs to be recapitalized, and all that is preventing China from going back to high growth. All they are doing is they are trying to digest that in the long term, but they do not have a growing population to grow into those empty homes, you know, and it's very difficult, and it's a lengthy process. The Japanese took almost 20 years, and the problem in China is bigger. The demographics is very similar, and the banking system also. So this is a problem, and therefore China is not really growing. I mean, the numbers published are dictated numbers. Europe is not really growing. The US economy is doing well, and a lot has to do with the employment situation. And that's really an exception. For the first time in modern history, we had labor demand or labor supply dropping below labor demand. And that has never happened before. And it's probably due to many during the pandemic leaving the workforce and not coming back. And therefore, this is a strange situation that supports the employment market. It supports real income growth. And then on top of that, you have a rising stock market and rising crypto market, and the balance sheet of the consumer looks strong, and therefore he doesn't save as much as he did before. He can spend, and therefore you do not have a recession that all conventional indicators suggested we would have. So it is at least delaying the recession by a long time, and it may lead to a soft landing or no recession until the situation in the employment sector really changes. And when it changes, then we could have a hard landing, but that could be 2 years down the road. So we have a situation, a strong US economy and weak China, Asia, and weak Europe. And therefore capital is flowing into the US. The US dollar is strong. It prevents US interest rates from going up. You have a strong economy, you have low quality spreads, and the Fed is cutting into this situation, interest rates. You know, they say they are adjusting, then they are adjusting down to the 2-year treasury rate approximately. So they are adjusting down to the so-called free market rate. But, you know, the economic situation doesn't request that, and they are cutting. And that may mean that perhaps the bubble will grow bigger first. And that leads me to 25. I think, you know, the 5th year in the decennial pattern is the strongest year in the stock market.
Okay.
The 7th year is the weakest. The 2nd year is the second weakest. The 5th year is the strongest. And over the last 120 years or so, I think there was one exception that was a down year of 1% or so. That was 2015. That was the exception. But normally the 5th year is strong. Now we have had 2 strong years. And it may very well be that due to the composition of all these factors, we may have a strong part of 25 into summer, and then comes the down cycle. Because at that time, I think, you know, the repercussions from tariffs and things like that will begin to backfire. And right now, the market is in the classic Santa Claus rally, which is usually from early December into early January. There are not many sellers around. Everybody wants to window dress this portfolio. There are performance fees to be collected, and you can you can window dress the portfolios, etc. That's what's going on right now over the holidays and into early January. And then we have a very stretched situation, and we may correct. The medium-term trend and momentum indicators are indicating that it's getting to, I mean, they are warning that we are late in the medium-term rise. And we could have a pause or a shakeout. I don't know what it will be. The shakeout could be 15% easily, 1,000 points or so, but it could be milder than that. And what we have on the monetary side is we have the debt ceiling coming into function in early January. And that means that from then on, they will run down the Treasury's general account, which is around $800 billion or so. When you run that down, you really inject sterilized money into the financial system, which is new liquidity. And the bubble, because it goes into the banking sector, and as it is in the banking sector, it is the financial system, and then it can be used for anything in the real economy or in the financial economy. And so far, it's sitting sterilized on the balance sheet of the Fed outside the financial system. So that will come into play into, let's say, spring or so, and that could help support the market or even drive it higher. I cannot tell you right now how the exact timing will be, but there are supporting elements and there are elements that are calling for a correction. I think the bigger problem will come in the second half, when the liquidity that has been driving the market over the last 2 years, which were the reverse repos that were driven down on the Fed balance sheet and came into treasury bills because Yellen was playing that game by not issuing bonds and more treasury bills, and therefore unlocking sterilized reverse repos by the money market funds that went back into the money market funds, into treasury bills. And as it is in treasury bills, the money is with the treasury and the treasury can spend it. So this was liquidity coming into the market, and it was the major driving force on the monetary side. The reverse repos are pretty much down. There is not much left. It's dry. So it's the TGA that can help a little bit. And after that, the liquidity game the Fed and the Treasury has played for the last 2 years is over. They could play a new game and they could go to QE, but going to QE would require that you have a problem first. You do not go to QE without any problem. And the problem could be that bond yields go higher because you need to depress bond yields and you buy treasury bonds to keep the yield down. This would be yield curve control. And this is an inflationary policy. That could be one problem, but there could be other problems. Another problem would be a shock to the economy, a deflationary shock to the economy due to tariffs or whatever, and then liquidity injection. So I think the second half of 25 will probably not be so good. I would guess a correction at the beginning of the year. How deep, I do not know. Then another rally to higher highs. And then it's probably the end of this mini cycle from late 22. And that could be the end of the cycle from 2009, because at that time we would be at new highs in valuation.
A lot to unpack there. But I think about,
did I confuse everybody?
No. It's brilliant. When I distill it, I sort of distill it into two buckets of real challenges: demographics and growth. Yeah. We have this colossal debt problem that everyone knows about, and we need growth to address that. And we have a demographic headwind. What do you make of my friend Ed Yardeni, who he's been so right on this market call for the last few years. One of the things that he talks about is artificial intelligence, and I would add sort of the promise of quantum computing as one of the big factors that could propel U.S. productivity growth up into the 2 to 4% per year range, which could at least stave off some of these problems that you're talking about. What do you think about that?
Well, that's an important point. I think new innovations, when they hit the market, when it comes into the economy very early, you usually have one boom. And that boom collapses because you overinvest, because everybody wants to be first, everybody wants to be one of the winners, and the winner takes all, so to speak. So you overinvest, and then you do not get the returns, and then the boom collapses. And then from there, it's the real boom that's coming on. I mean, in that collapse of the internet, Amazon went down 90% in that first collapse of the first boomlet, after that. And the same thing could happen with some of the AI heroes that we see right now. And I think it will come back because it's an innovation to stay. Artificial intelligence has been here for a few years already. I mean, I have been able to talk to my car that I'm driving for many years now. And the car talks back, etc. So this is artificial intelligence, and it gets better and better and better, of course. And I recently had a breakfast with a famous growth investor, and we talked about this. And the person said, "Well, we will have a lot of productivity gains because we will do the manufacturing all through robots and artificial intelligence. And
Sure.
I can see that. But even if you are successful in doing that and applying that, it will not happen during the Trump years. It will take time. It's a timing issue. So I think you first have a problem, a bigger problem, and then it will come off. And
Okay.
we talked before with Neil Howie about the force turning, etc.
Yes.
From the early 30s on, you have a new long cycle. And I think artificial intelligence in that new long cycle will play an important role. No question about it. I'm just not sure whether the next few years will be as good as the rosy prices suggest right now. I doubt.
Do you think we enter a time, Felix, where you brought up Elon and Vivek and the Doge government efficiency drive? I mean, do you think that there is the will in the United States, where you spend a lot of time, to sort of go to the Javier Milei austerity strategy early on in this presidency? Because if he's going to do it, he has to
Yeah.
do it like January 21st, right?
Yeah.
He's got to go early.
Yeah, and what he's doing is very painful at the beginning to the people.
Yeah.
Very, very painful. And he can only do it because Argentina is down on its knees. I mean, I have traveled to
Yeah.
Argentina many times. I know the country a little bit, and it got from bad to worse and the worst. And I could not imagine how worse it would eventually get until somebody like Milei was coming on. So the US or any industrialized nation is not at that point, is very far from that. And you fight the bureaucracy. And, Trump stood up and said, I will dismantle the deep state. I hope he will be successful in that, but I really doubt it. And
Okay.
the deep state, part of the deep state is the bureaucracy. And the bureaucracy is extremely powerful. And you can go to every government in the industrialized world. In most cases, it's the bureaucracy that drives the leading politicians and not the other way around. Trump may be an exception, and I hope he can achieve his goals because that would bring a good example to the world. How could operate and improve the situation structurally? Because this is a structural attack,
Yeah.
and I hope he will achieve it. I have my doubts. I think it's the situation in the U.S. is too good to be successful on that front.
Okay. So, having said all of that, Felix, let's talk about how to invest. I mean, just broadly, is now the time to look at commodities, real estate, energy? What do you think about the big sectors?
I think we are near the end of the cycle from inequities from 22 and probably even from 2009. And
Mm.
26, the latest, if it doesn't start in 25, will be a serious bear market. But I also think that commodities are coming toward the end of their correction after the first move up they had from the 2020 low. And I think if I'm right that we will have some sort of deflationary shock, not deflation, but a deflationary shock to the system, and probably from China or from Japan strengthening the yen. We can talk about that because that's an
Mm.
important topic. Uh, when we have that shock, then I think what you will see is that fiscal policy and monetary policy together in the whole industrialized world will go into overdrive and really become extremely stimulative. And that's when you want to be long commodities, long material stocks, long value stocks, and not long growth stocks, high technology stocks.
Okay.
And I think that change is coming, but I think early in 25 is too early.
Okay.
I would rather see that later in 25 or 26. Yeah.
Okay.
Later in 25, maybe. Yeah. So that's commodities. I mean, gold and oil are two important commodities. The base metals are sloppy. They are not doing so well because 50% of those base metals is consumed by China, and the big infrastructure boom is over.
Right.
Um, gold is gold is money. Um, Unlike dollars or euros that are credit, they have a liability on the other side. Gold doesn't. Gold is money. And gold is a reflection of the fiat currency system. And what I described at the very beginning, that we go deeper into state capitalism and repression and things like that, means that we continue to debase our currencies, paper currencies. And that is very bullish for gold. So I think the uptrend in gold continues. Around 2,800, it was a little bit pricey, and the BRICS central banks stopped buying from 2,400 to 2,800. That was Western investors. I think gold is probably in a trading range between 2,800 and 2,400, and I would be buyers as it comes closer to the lower end of the range because I see it eventually over 3,000 and way beyond that if the scenario doesn't work out well for the world. It will work out well for gold. That's your insurance. You need to have some gold in your deposit. Oil is another important commodity, and the world thought that we could get off fossil fuels with green deals and all that kind of stuff. That won't work. Maybe in 100 years, but not in the next 30 years. I think we are underestimating the demand for oil and gas, natural gas, and fossil fuels in general. And I think we have seen with Germany that changed in extremis, so to speak, where it could lead to. You price your economy out of international competition if you do it. So I think the pendulum will swing back to oil. However, the drilling for oil in the last few years, because of the Green Deal, has gone down. And
Mhm.
we have not been searching for new oil. And I think that will lead to a shortage at some point of time. I do not know exactly when it comes, but over the next few years, I would like to be long oil on a strategic basis. I also think in the short term, the downside is probably the low 60s and the upside probably the low 90s. I guess that Israel and the US will try to attack Iran or some of the nuclear facilities, and there will
Mm.
be a war. And such a war could really drive the price of oil higher in the short term. And at that time, when that happens, the world will wake up and see, oh my gosh, oil remains important and we have a shortage of supply. Right now, the market is well supplied physically, and that's why oil is trading sloppy. But I think looking out 2 years, 3 years, I see oil trading at 150 or something like that.
Oh, wow.
And oil at 150, and that's the one thing I wanted to mention. No real bear market in the past has happened before oil has not gone up. You need, as a prerequisite for a
Okay.
bear market, you need a higher price of oil because a higher price of energy leads to inflation. Inflation leads to tighter money, and tighter money leads to a bear market. So that's the sequence of events, so to speak.
Okay. How just out of, you're European, you're Swiss. How does Europe stay warm this winter? I mean,
Good question. Good question. I tell you something. When I'm in the US, the lights are on all day. Christmas lighting is on all day, whether it's dark or not. Nobody turns it off. And here we have Christmas lighting from 6 to 10 or something like that, and then it is turned off. Last year, we could turn it on only for 2 hours, you see, and governments told their citizens that they could not turn the heating above a certain temperature and things like that because we have a shortage. When I talk to my American friends, they do not know what I'm talking about. But that's the situation in Europe. And the Europeans, the Germans in particular, when they do something, they do it 150%. And it seems to me they went into the Green Deal and somebody said, well, if we go the wrong direction, then at least at full speed. That's the German mentality. And the Swiss are a little bit similar, not as extreme, but a little bit similar, and others also. The French have a lot of nuclear power,
yeah.
but they need uranium from the Russians, and from Kazakhstan and things like that. So that's a problem. And I think Europe has priced itself out of the world markets in many ways. It has lost competitiveness. I can tell you, Germany, for instance, Merkel was a horrible chancellor. And I was criticizing her from the very early stage on because she didn't make a lot of decisions, but all the strategic decisions she made were wrong. And when they entered the euro in 2000 or 99, it was, I think, they had unit labor costs that was 30% the average country in the EU. Very competitive, very
Wow.
powerful. Now they are 6% above. They are priced out.
Mhm.
Italy is more competitive, and that tells you when you make mistakes in economic policy, it has a result. And prosperity doesn't fall from the sky. You have to earn it. You have to earn it. You have to work for it. And that is what these ideologists have forgotten. And I think the Europeans, what I see going on politically, are not ready for the turn yet. I think Germany will
Yeah.
have elections in February. The guy who comes on will go into a coalition with the left parties and just to stay in power. And they will not do the things that are necessary. The EU is world champion in regulation. For a turn, they should become champion in deregulation. You see, they do not get it. They do not get it. They are sitting in the ivory tower, and that means it will get worse before it gets better. So I see Europe in a structural crisis recession for the next 3 to 4 years.
Wow.
Yeah, it's really ugly.
So you mentioned Japan earlier, and Japan is just such an interesting country. Coming out of, like you mentioned, a 2-decade malaise, with massive demographic headwinds as well, but much farther advanced than the U.S. or Europe. What are your thoughts on Japan, and how does the yen impact the rest of the world? Because I think a lot of people don't understand that.
Yeah, that's an important point. First of all, the malaise that we have seen previously in Japan really forced the corporate sector to do its homework. And the corporate sector Japan is now strong and healthy. They have
Mm.
strong balance sheets. They have good cash flow situations. They are in good fundamental conditions. They are very competitive also. Of course, the falling yen has helped. And the yen, as I said, compared to the US dollar, it went from 80 to 160. That means the yen was cut in half relative to the US dollar. And knowing what Trump has in mind, I wouldn't like to be in a position of the Japanese prime minister visiting the White House. You see, it's
Mhm.
very obvious. It's very obvious what song Trump will sing, and of course the Japanese are beginning to work on that. And the Japanese central bank, they have 2% inflation. The economy is doing so-so, okay, not very robust, but okay, a little bit better than Europe. And they are saying we have to move away from our extreme low interest rate regime. And it's the only central bank talking about hiking interest rates in 25.
Yeah.
And as they are hiking interest rates, and the central bank, guided by the government, wants to strengthen the yen because of trade situation, that has an important influence on world liquidity. Over the last 10, 13 years or so, when the yen weakened, it was not only the currency that weakened the most, but weaker and weaker and weaker, but it was the currency with the lowest interest rates, zero interest rates.
Okay.
So it was the ideal funding currency for all sorts of investment projects, be it in the real economy or be it in the investment markets, in the financial markets. And therefore, the short position in yen is gigantic. And it works as long as the yen continues to decline. When the yen begins to turn up, you will have an ongoing short covering procedure that runs a few years, and that will strengthen the yen. And that means the first period when it weakened, it was creating liquidity, and now it will withdraw liquidity. And actually, when you look at the correlation of the real Japanese bond yield with Nasdaq earnings yield, the reciprocal of the PE, over the last 2 years, it was like this.
Wow.
It
Okay.
goes step in step.
Okay.
So if Japanese real interest rates go up, then of course the earnings yield of the Nasdaq will also go up, which means the P will go down. So the yen strengthening is a sell signal for the Nasdaq. And if it's a sell signal for the Nasdaq, it's a sell signal for the S&P. And if we have a sell signal for the S&P, it's a sell signal for all the stock markets in the world. So
Wow.
the yen is sort of a liquidity proxy of global financial liquidity, not just US, but global financial liquidity. And I think this is very important to understand.
Can the dollar weaken? I mean, it's all relative, right? But can Trump effectively weaken the dollar without triggering all of the negative implications of a stronger yen?
Well, when the trading partner has a stronger currency, he becomes less competitive, of course. And I thought that Trump will first try with tariffs or announcing tariffs, and then if the currency moves and the dollar weakens because the other currencies strengthen, then he may not put on the tariffs. We do not know. That's all
Yeah,
out in
right,
limbo.
right.
But the game is clearly to make the US more competitive and to keep a lot of the imports from other countries out. And the best would be to import the production facilities into the US and produce domestically what is imported so far. That's the goal. And it may work over the long term, but it's a tough fight. It's a tough fight, when you try to change the world regime, the trading regime in such an aggressive way, there could be casualties,
Yeah.
and financial markets occasionally could be shaken. That's what I think we should keep in mind for 2025.
Felix, I could keep you for another 2 hours. It's just always fascinating speaking with you. Let me just ask you one last question, and that would be what important point or question should I have asked you that I didn't? Did we miss anything?
I think investors should be aware of that the last 2 years are not the norm. They are part of a bull cycle, but a bull run is cyclical. There is a bull run followed by a bear run. And I think in the last 2 years, it was correct to manage the opportunities. In the next 2 years, I think it will be important to not forget managing the risks.
Great word,
That's
stand by.
okay.
Yeah.
Yeah. Okay.
Thank you, Felix. I very much appreciate your time, as always.
My pleasure, Ed. Thank you very much for having me and all the best.